Good afternoon to all. Welcome to yet another one day of learning, which we are doing as a 7 series program, and today being the fourth one. And rightly said by Acharya sir, this is Saptarishi, and 7 past presidents are going to address us. And today we have with us Subodh Kumar Agarwal sir, who has been a great motivator to many of us in the entire process of learning. So welcome to you. Welcome to Guru Raj sir, who's a learned speaker from Bangalore, and it's been always a privilege to actually share and screen with him, who shares by his heart. He talks from his mind, but shares everything from his heart. He loves the profession to a level where he wants error-free profession at all times. So welcome to you, Guru Raj sir. With me, I have Nidhi also, and office is attending the program. And friends, welcome to each one of you to this fourth day program. Today, it's undoubtedly an interesting part of discussion, which is with regards to compliance with accounting standards and auditing standards. There cannot be a better person than Subodh Agarwal sir to actually give an opening remark on this particular part, because he's gone through a beautiful journey as a council member, then as a president, and also today one of the most sought after IP professional and a person who has understood the standards at the back of his hand. And the point which I would like to mention, just to take you back, 4 sessions what we had was how to scale up CA firms. So sir, for both of you also, just for a quick update, first session was on 24th July, where we talked about scale up CA firms, and we had Nilesh Vikamse ji and Guru Prasad ji, who's actually come and addressed the members. Number 2 was on 28th July, which was engagement team and engagement performance evaluation, where Praful Charger sir, our past president, and Vijay Totopalli from Hyderabad has addressed our members on the entire SQC requirements of the engagement performance as such. Last one was on 4th August, where audit documentation for small and medium practitioners, where Mr. Balaji specifically talked about that whether you are a small or a large firm, standards are applicable to you, and the compliance of documents has to be done in all. This was also been specially addressed by our past president Amarjit Chopra ji. Today we have Subodh Agarwal sir, and in time to come, every Wednesday till 28th, we are going to have this session every Wednesday from either 2 to 4 or 1 to 3. So this is what the background is. There is much more in today's session to go through, which is going to be spoken by our learned speaker, which is on accounting standard, non-compliances which are commonly observed, then accounting standards, non-compliance, specifically those following cash method of accounting, and application of accounting standard for non-companies, that is tax audits also, and much more. There are very interesting things which I don't want to talk more, because you will actually start feeling when is the next going to come. And we have our learned speaker to talk on it. But before the learned speaker comes, it's always important, the person at the helms of affair, that 2 years journey, particularly as a vice president and then as a president, makes whole lot of difference. And the way we look as a council member, and the next day when you become a vice president and a president, the way we actually look at the profession completely changes. And one such person who is there with us today is no other person than Subodh Agarwal sir. Sir, I request you to kindly give your words of wisdom for our members who are participating in large numbers, and the way we requested members, and we took this time specifically because having your lunch, listen to the discussions, because these are all things which we have gone through on time and again, basic studies. But what has happened in the process of run, that we have lost the fundamentals. And that is where the question is coming back for most of the chartered accountants. How do we go back to it? So accounting standards and auditing standards are those 2 legs of our profession, which actually maintains certain level of standard in the entire process. That's the reason it is called standards of auditing, standards of accounting. So over to you, past president sir, Subodh Agarwal sir. Look forward for your words of wisdom.
Thank you, Dayanivasji, for carving out and formulating such a wonderful program. In fact, my office team also attended the last few programs, and they were very appreciative of the module, the way it has been restructured. So, compliment to you and your team for coming out with this 7 Saptarishi program, and then giving the opportunity to the old timers to share those their views, because nowadays very few people will find those who are interested listen to our views. But then you are imposing on all the listeners today, participants, because of Mr. Acharya, who has gathered here today to listen. But now in the beginning, they are listening to me. So, and then Mr. Acharya for sparing your time also. And then I also find that my good friend, Mr. Sushil Goyal, is also present today. Thanks for giving me this opportunity to share my view on peer review. In fact, nowadays, I am not much on audit and income tax. I am doing some other assignments, because as we know that chartered accountants are can do multifarious activity, and they are multi-dimensional things they can do. So in that direction, I also, when we found that some new kind of verticals can be created, why not to capture and grab those opportunities? But whatever you do, Dayanivasji, Acharyaji, and Goyalji, and other friends, those who are looking at, we are professionals. Why we are called professionals? We are called professionals because we have to standardize ourselves, and we have to follow. We should be kind to our issue and our regulators, that they have come out with this standard, so that we can follow the standard and we do not deviate. They give us a framework, that within that framework we need to work. And if we introspect ourselves within the framework, we will find that probably we are not doing anything wrong. I'll give you an example. If you look at the auditing standard, now probably I'll give you an example of the CWAM, this software company, Raju software company, Hyderabad ka Satyam. If you look at the Satyam, in Satyam, what happened? Around 5 to 6,000 crore rupees of the bank FD were manipulated. Now, what our standard says, the standard says, auditing standard says, it says that you need to have the external confirmation. Now, if the auditor has obtained the external confirmation, who will give the external confirmation? Bank, promoter, the CEO, probably no CEO, no bank. Third party is the bank. If you have written to the bank, and if bank got manipulated and bank has written you, confirmed you that yes, 6,000 crore rupees FD is there, then probably nobody can pinpoint you and put you on the dock. So you are safe. Now, if you have followed this standard and somebody else has done the manipulation, so you cannot be hauled up. So that is the standard where it comes to your rescue. Now there are two things. Now coming first to the peer review. Now what the peer review looks at, what Dayanivas as a chairman in the peer review looks at, it looks at the compliance with technical, professional, and ethical standard. It looks at the reporting also, the quality of reporting also. Probably there is again, we have got the standard in the form of the auditing standard, in the form of the SQC also, and then the system and procedure for carrying out the assurance services. Now, for system and procedure, there may not be standard, but there are laid down rules and regulation, and the framework and the materials are there which you can look at. Now, my dear friends, now the question that will come, because today the topic is complying with accounting and auditing standard. Now, my first question to my speakers is whether all these standards are required to be complied by the practitioners. My question is no. My question is there are some standards which are required to be complied by the professional, and some standards which the professional need to see that they have been complied or not. I mean, let us give the example, accounting standard. My question is, who has to comply with the accounting standard? The chartered accountant? No, never say that you have complied with the accounting standard. Because the moment you say that you have complied with the accounting standard, that means you have become the accountant of the company. The accountant need to comply with the accounting standard. But my duty as the auditor is to see that the law of the land. Now, accounting standard, again, today it has become the law because of Section 133 of the Companies Act, whereby it has been regulated. Now we, as a chartered accountant, becomes our duty to see that accounting standard has been complied or not. And if it is not complied, we need to report. Can, as an auditor, I ask the company to change the accounts, books of accounts? Theoretically, no. Practically, we do. I mean, again, there is a thin line which are to do or not do, because we cannot wear the hat of accounting as well as auditing. As we say theoretically, wear the hat of the, you need to where the accounting ends, auditing starts. So we need to get the books of account, get the accounts, and then we start, and whatever we have to report, we can report only through our audit report. We cannot account the notes on accounts. We don't have anything to do with the notes on accounts. Sometimes in our audit report, we refer to the notes on account. That means what management has said, and on top of that, you give your comments. Now, coming to the account auditing standard, yes, this is my Bible, this is my Quran, this is my follow that, need to comply that. So as an auditor, I need to see that all the accounting, how to put my documentation in order. I need to look at section SA 230. Whether there is a fraud and there IFC, etc., we need to look at 320 or whatever, 315, whatever standard on auditings are there. So we need to first be very clear what are the standards that we are required to follow and comply, and what are the standards where we need to report. That differentiation we need to understand so that we do not wear both the hat as a auditing and accounting. Otherwise, if you don't pick up the phone of Dayan or Sharma, you may be directed towards the disciplinary committee. So in disciplinary committee, again, all in lighter vein, but then as a chartered accountant, as a professional, sometimes we intermingle that no, accounting and auditing, everything we need to do. Now, in the peer review, what the peer reviewer is looking at, he is only looking at that even one person's wrongdoing hampers the image, tarnishes the image of the entire community. There is, say, 300,000 members. If 300,000 members, one member signed the wrong balance sheet, signed the wrong financial statement, what people say, oh, तुम्हारा chartered accountant ऐसा ही है. Oh, the chartered accountant does not care, and they just sign the financial statement just without looking at all the standard. No, that is the reason probably the issue is now emphasizing more on peer review. And now the question comes in, peer review is done. Whether the peer reviewer are competent. I mean, the reviewer the reviewer, who can be the reviewer? Probably they has already shared with you, and they are and the current team, I'm sure that they have ensured that they are fully updated. They are up to mark, and when they go anywhere, they are more knowledgeable, more experienced to do the peer review works. And friends, the best part of peer review is, and why I was going through the manual, and why I feel that we should come forward to get our form peer reviewed, even if we don't fall within the category of 1, 2, 3, and it is not subject to peer review. The reason being, the person who is coming to review us are none other than our colleague. He will be, let him be for the time being, even if he is lesser in age, let him be our mentor, and he will be guiding us that how to maintain, and he will be pointing out deficiency only for the sake of making us understand where we were falling. What happens, friends? As we always say, the doctor cannot do the operation of his own family members. We may be having many chartered accountants in our firm or many professionals, but if you ask them to do our own peer review, probably they may not be doing that objectively. If the outsider friend comes, I mean, if there comes to my office or I go to their office or vice versa, then we will be doing it very objectively, because I don't know what they may not be knowing what I am doing, and they will be doing it from the scratch and from objectively purpose. And whatever Daya will be pointing out to me that, see, these are the things, these are the places where you can improvise. I will not say deficiency, where you can improvise. So that means Daya is guiding me. A professional is sparing his valuable time and guiding me what to do, how to improvise my form further. Because today is the competitive era. I mean, in competitive era, we are looking at through multidisciplinary partnership and through and scaling up our CA forms. Unless and until we upgrade ourselves by way of the form upgradation, our knowledge upgradation, probably we will not be able to scale up the form, and that will always remain on papers also. I have seen through my council journey or through my practice journey also, those form was focused on quality, technical, they have been able to improve faster. My dear friends, since I am practicing since last 30 years, the kind of change in Indian economy has changed the mindset of our clients also. For the same audit or same consultancy work where we used to get 1,000 rupees, today they are ready to pay 10,000, 20,000, 50,000 rupees. The reason being, today the litigation costs are very high. Today, the penalty punishments are very high. 15 years back, you could have done anything. You could have filed the return in MCA by paying 1,000 rupees. For the same thing, today you are paying 25,000 rupees. And there are then litigations, other litigation scope also. So there is no scope for getting it backdated correction. And that is the reason that now the specialization is also coming up. So that perspective, let me compliment Dyanavas by organizing this Saptrisi program, which is very wonderful. As I am not attending, but my team has attended and they are very appreciative. So my only question to Dyanavas will be, I am doing insolvency case, whether it will be falling within the definition of attestation work. So if you can examine and let me know, because again, my peer review has already been done, though it is in the individual name, it is not in the firm name. But in individual name also, the issue can always, other than the firm also can do the peer review of the individual also. So offline, if you can tell me, so that I can prepare my book of account accordingly. Thank you, they are very much. Thank you very much for giving me this opportunity and sharing my thoughts on peer review.
Thank you very much, Subodh sir. One thing I would like to say, it took 18 years for us to reach here. 2002 was the year. Guru sir, just for your information also, 2002 is the year in which peer review board was being formed, and since then we are actually moving forward in a different direction. And now we are moving towards a situation where, sir, I can only tell you is that, the past presidents of the institute have had that kind of wisdom to tell what was required, whether you talk about DISA, which is the most relevant thing today. When we talk about peer review, QRB or anything which is there, we have been forward looking, but only thing is we had to encourage our members to move forward. Couple of responses to you, Subodh sir. Point number one, you talked about the capability and capacity of a peer reviewer. So after 18 years, last year we introduced the concept of assessment test for the peer reviewer. The peer reviewer has to pass an assessment test, then only he can continue as a peer reviewer. That is what we want to add value to the system. Point number two is, sir, the most important part is peer review process globally. Our institute stands on the top. I can tell you if we are effectively implementing it, because this is the only institute which is having peer review process within the system. And it is not a punishing body. It is actually a body which is guiding the members to not go wrong at right time, at appropriate time. I mean to say, it's a hand-holding body, which is the most important part. And thank you very much, sir, to tell everyone to get themselves peer reviewed, whether you are falling in a category of compulsory or non-compulsory. It is important that we do a self-assessment on a continuous basis. At what time situation will affect us, we do that assessment. If it is done by a peer, it will be the most appropriate thing. Really, thanks to you all people who have thought about it, that, at least my family member is coming and telling me, look, this is where the gap is. Kindly, modify or enhance the quality here. So this is something which is there, and more importantly, the last one, the role and responsibility. What is the role of a client and what is the role of a chartered accountant is something which you have rightly put on. Thank you very much, sir, for giving your continuous years in your branch, region, central. It takes a lot of time and energy to be part of the entire body, and you have held the hands of affair at the institute, and you have guided us always. Thank you very much for coming and joining us, giving your words of wisdom to all our members. Thank you, sir.
Thank you, Dayaji. Thank you, Dayaji and Mr. Acharya. My apology for not being able to continue because I have some other commitment also. But next time, definitely, I love to listen to you because you are one of the very learned and celebrated.
Before you leave, sir, I just wanted to say one thing, that you mentioned that you are an old timer. Sir, I wanted to tell you that gold will never become old. So you are a gold timer. In fact, our institute, sir, I mean, in the standards on auditing, I always say professional judgment is very important. And what is professional judgment? It comes out of your training, your experience and knowledge. Training, knowledge and experience. And the experience of being the president of the Institute of Chartered Accountants of India, I think less than 75 people in India and maybe less than 70 or so living legends will be there. I think Daya has done a very good job of bringing the golden timers. And I mean, just now we coined the term Saptar Rishis. We have at least Saptar Rishis, 70 Rishis, living legends in that sense. Each one of them have a great voice and have taken the institute to great heights. So salute to you before you sign off, sir.
Thank you, sir, for your nice word.
So, Subodh, adding with that, gold will not get old, and you are wearing a yellow shirt. Thank you, sir.
Thank you.
Thank you, sir. So, friends, I think we heard our past president speaking. I don't think any other language actually comes out in whatever form it is. Guru, sir, I think, the most important part is the ethical part. The second part is basically how we are actually showcasing our independence every time, whether we like it or not, we need to demonstrate. And the most important part is the standards cannot be ignored. Whether I sign a certificate which is of a free of cost of a charitable organization which we do a sumoto contribution to the society as a CSR, which is actually a big recognition of a chartered accountancy profession. Equally, when we sign a balance sheet of few thousands of crores, it doesn't make any difference. Standards need to be complied. It cannot be actually ignored at a given point in time. And there cannot be a better person than you to come and talk on this compliance of standards on accounting as well as auditing. Over to you, sir. We are all eager to listen to you.
Thank you, Dayaji. I think you have done a very good job of setting in motion and adding value to the chartered accountants by bringing out such very nice programs. I should really congratulate the entire peer review board team for coming out with a program like this. And I always say that, afternoons are not the best time to listen to standards on auditing. But then I think what you have done is you have respected the time in that sense. I always say 230 is essay documentation. Essay 230 is on documentation. So about time on essay 2, it's about 230. And I always somehow in all the conferences also, I was asked to talk on standards on auditing, especially documentation at 230. So that way, at least one standard everybody will remember that 230 means as documentation. So, and probably during the lunch time, I am sure a lot of members are and I keep telling this, what you put in here goes down. What you put in here and here goes up. That way, I think you are now enabling the people to put down, which goes to Madhya Pradesh. But then also during the process, you are enabling people to add value to their Uttar Pradesh. So that way, thank you so much for the timing also. I'm happy about this timing because at this point, no big appointments are given to the clients and therefore people are sort of free. And during having their lunch, they can probably have this also for lunch. So I think that is how you have programmed. Thanks to Nidhi and the Vice Chairman Rajesh Sharmaji and also Goyal, who is there on the screen. So now let me put up my questions specifically. I have, in the next 1.5 hours or so, I want as many questions to come also. As you are munching your food, you can also key in the questions which I will be taking up at the end. But today what I'm going to do is I have put up 16 questions. In the process, I will answer, unravel the compliance requirements of standards on audit and accounting standards. So first, my question is it mandatory to comply with accounting standards and standards on auditing? Who must comply with the accounting standards and standards on auditing? Mr. Subodh Kumar Agarwalji, the past president, rightly said accounting standards is the domain of the preparers of financial statements, whereas standards on auditing is the domain of the chartered accountants who are auditing the financial statements. What are the implications if accounting standards and standards on auditing are not complied with? So we will see that. How many accounting standards are there in India? What are the normal non-compliances observed in accounting standards? In case of non-companies subject to tax audit, are accounting standards applicable? So we will see that. Whether accounting standards for non-companies apply if they follow the cash system of accounting is what we will see, cash method of accounting. That is a very important question which I keep getting across. And the tax audit report, all of us know, we certify Form 3CD as the information contained in Form 3CD as true and correct. Does it mean that we are giving an absolute assurance to the department as against a reasonable assurance which we give when we sign off the statutory audit report as true and fair? Then extending that particular question, can test checks be used when we are actually doing tax audit? Is what we'll look into. And how many standards on auditing are there? How many standards on auditing are there? Are they all mandatory? And regarding audit documentation, I've been told that Balaji spoke last week as to how many years should the audit documentation be preserved? By what time should the audit documentation be assembled? And finally, two questions which always are very close to my heart is, who is the auditor working for? Who is the auditor working for? And we answer one very painful question. Why is it that in spite of so many standards, accounting scams still happen? So we will answer all these 16 questions to the presentation which I will put up. I will now share my screen. Yeah, in the meantime, please feel free to punch in as many questions as possible. We will take it up at the end. So this is a wonderful brochure which the peer review board has done, and the topic which has been allotted to me is complying with accounting and auditing standards. A very vast topic in that sense. Last week you spoke only about SA 231 standard on auditing. So today I will be covering the maybe the cover page of both accounting standards and standards on auditing. That way a very wide possibility as far as I'm concerned. I can go anywhere. Having said that, I have restricted myself to these 16 questions, which I have already sort of spoken at the beginning. So I will take up each question and try to unravel the compliance requirement with respect to these standards. My first question is it mandatory to comply with accounting standards and standards on auditing? Of course, the answer is yes. The answer is, of course, a big yes. Now, when we say yes or no, we cannot just stop with yes or no. We have to talk about the source or the exact technical requirement as to where is it told that compliance of standards on auditing and accounting standards are a must. Now, if you go to the Companies Act, Section 129, which talks about financial statements, it says that every financial statement must be in Schedule 3 and must comply with all accounting standards, And what are the accounting standards? Accounting standards, again, are told in Section 133 of the Companies Act to mean that the standards as the central government, the standards as prescribed by the central government. And the moment we say prescription, the moment we talk about prescription in the Companies Act, it means the prescription comes through the doctors. The doctors are sitting in the ministry, though the ministry will come out with a notification of various rules, and it will not be the Parliament, President, Rajya Sabha, Lok Sabha that will pass the act, but the prescription will come by the ministry, and that particular standard, which is given in Section 133 on accounting standards, is the one which has been prescribed in the company's accounting standard rules. I will talk about that a bit later. And 133 goes on to say these standards are those which are recommended by the Institute of Chartered Accountants of India, which is prepared in consultation with the NAFRA. Until such time these are prepared, you follow whatever is already there in the company's accounting standard rules. For the moment, let me tell you that right now, although we are talking about Companies Act 2013, the company's accounting standard rules predate the act itself. In fact, we are referring to the company's accounting standard rules 2006. Companies Accounting Standard Rules 2006, which prescribe the accounting standards. Now, having said that, standards on auditing, we'll talk about standards on auditing. Where is standards on auditing? Although we know that standards on auditing are prepared by the Institute of Chartered Accountants of India, and we have got compendium of accounting standards. It is not just the Institute of Chartered Accountants of India which says that standards on auditing has to be complied with. It is also told in section 143 of the Companies Act that every chartered accountant who is doing the audit under the Companies Act must comply with standards on auditing. Section 143 subsection 9 talks about the compulsory nature of standards on auditing, and 143.10 goes on to say what is a standards on auditing. Standards on auditing are those standards which are again prescribed by the central government, recommended by the Institute of Chartered Accountants of India, and in consultation with the NAFRA. Now, one may see that are there any standards on auditing which is there in the rules, as told by the Ministry of Corporate Affairs? Now, there it is still not there. And section 143 subsection 10 in the proviso goes on to tell that till such time the rules are framed, you shall follow the standards on auditing as available in the Institute of Chartered Accountants of India, as already made available through the Institute of Chartered Accountants of India. So the answer to the first question is it mandatory to comply with accounting standards and standards on auditing? The answer is yes. The answer is a big yes. And our institute goes a step forward. Not only for companies, but even for non-companies, accounting standards are sort of compulsory, not directly on the let us say a partnership firm or a proprietorship concern, because our institute cannot have is not a regulator for a proprietorship concern or a partnership firm, but indirectly it is through the chartered accountant who is attesting the balance sheet of the who is signing the financial statements of such a proprietorship concern or a partnership firm. He has to ensure that the accounting standards are complied with. And of course, when such a chartered accountant is doing the attest function, it is mandatory that even for non-companies, he has to comply with all standards on auditing. So that answers the question number one. Question number two, who must comply with accounting standards and standards on auditing? Our past president, Subodh Kumar Agarwalji, rightly already answered this question, but then I had put this question before, so therefore let me answer. Who must comply with the accounting standards? Naturally, the people who prepare the accounting, who prepare the accounts, who prepare the financial statements have to comply with accounting standards. And should the auditor comply with accounting standards? He need not comply with accounting standards in that sense. However, if the company does not comply with a particular accounting standards, he will bring about the non-compliance in his audit report. Now, who should comply with standards on auditing? Naturally, a company need not comply with standards on auditing, but a person who is doing the auditing of such financial statements has to comply with standards on audit. So a very clear-cut demarcation. As Subodh Kumar Agarwalji rightly said, I cannot as an auditor say whatever I want in the financial statement, just like the preparers of the financial statement cannot have a say in my audit report. So very clear-cut demarcation, a clear-cut jurisdiction is already laid out, and we'll have to comply with that particular jurisdiction. Now, what are the implications if accounting standards and standards on auditing are not complied with? Well, let me just take up the specifics there. Section 129, I already referred. Subsection 1 says the financial statements shall give a true and fair view of the state of affairs of the company, which is foremost. Please understand that we always sometimes say, which is superior, true and fair or accounting standards? If there is a tiff between the true and fair and accounting standards, one has to respect true and fair. But of course, we have to see where in such a situation, the accounting standard itself has to be rectified. That's a different subject altogether. Having said that, the supreme objective of the financial statements is to give a true and fair view of the state of affairs of the company, and it shall comply with the accounting standards notified under section 133, which I just now mentioned, and shall be in form or forms as may be provided for different class of companies in Schedule 3. Now, Schedule 3 has undergone a change, but we have all resolved that that particular Schedule 3 change will be applicable for the current financial year 21-22, which we will be signing off next year. The new Schedule 3, please be forewarned, that asks for a lot of additional information. I mean, I have tabled out about 25 additional information and 10 changes in the terminologies or certain requirements already there. 25 additional disclosure requirements coming out of the revised Schedule 3 applicable for the current year, which will be audited next year. Now, so we have to comply with accounting standards. Now, the question is, if you do not comply with any of the requirement of section 129(1), either true and fair view is disturbed or not properly projected, or the accounting standards are not complied, or the format of the financial statements is not in Schedule 3, then for the contravention, the company which contravenes will have to face the music. And what is the penalty? The managing director, full-time director in charge of finance, the CFO, or any other person charged by the board with the duty of complying with the requirement of section 129, and in the absence of any of the officers mentioned above, all the directors shall be punishable with imprisonment for a term up to 1 year, or with a fine of rupees 50,000 or 5 lakh, or with both. So that is the penalty prescribed for non-compliance with section 129. What about the auditor? Now, as far as the auditor is concerned, as we already discussed, auditor shall only report whether in his opinion the financial statements comply with the accounting standards. He has to make a very specific statement that all the accounting standards have been complied with. Otherwise, he has to bring out the non-compliance of the accounting standards and also qualify such an audit report using SA 705. Now, what about the penalty for such a chartered accountant? Very interestingly, in the Companies Act, they have not prescribed the penalty for a chartered accountant for non-compliance of section 143. Very interestingly, that was dropped. Earlier it was there was a penalty for the chartered accountant also. In the Companies Amendment Act 2020, they have dropped the penalty because this will now be either under the jurisdiction of the Institute of Chartered Accountants of India or under the jurisdiction of NAFRA to levy the appropriate penalty or any other punishment that the Institute or NAFRA wants to give on such a chartered accountant. Now, having said that, Section 133, what does 133 say? Central government to prescribe accounting standards as recommended by the Institute of Chartered Accountants of India in consultation with NAFRA. Now, we already saw that prescription of accounting standards is now in the Companies Act 2013. We were all the while referring to the prescription of the Companies Accounting Standard Rules coming out in 2006. So even for the financial year 2021, I am referring to the accounting standards as prescribed in Companies Accounting Standard Rules 2006. But very interestingly, what happened is on 23rd of June 2021, the ministry came out with a 388-page Companies Accounting Standard Rules 2021, wherein they literally copied and pasted whatever was already available in Companies Accounting Standard Rules 2006 into Companies Accounting Standard Rules 2021. What was the need for them to do that? When it was a 388-page document, which was a verbatim reproduction of whatever was there in the 2006 rules, they brought it down into 2021 rules. This was brought in to bring about the rules in line with the Companies Act 2013, because the rules should be after 2013 Act, because the Act itself was on 2013. So after 2013, we were referring in 2013-2006 Act rules, which was told in Rule 7 of the Companies Account Rules 2014. The Companies Rule number 7 of Companies Account Rules 2014 said, till such time we come out with our own rules in the Companies Act 2013, you follow the Companies Act 1956 rules on accounting standard, which was given in Companies Accounting Standard Rules 2006. So we were following in 2013 Act, 1956 Act's Bacha. So now we are following the Bacha of the Companies Accounting Standard, Companies Act 2013 itself, by virtue of Companies Accounting Standard Rules 2021. But a point to be noted is, this notification dated 23rd June 2021 will be applicable for the current financial year 21-22, and therefore we will refer to this particular Rules 2021 in the next financial statement which we are preparing, or rather for 2021 we'll still be referring to Companies Accounting Standard Rules 2006. So what are the other changes that were there here? Only thing is, they have made a small classification change. All of us know that companies are of two types, SMCs and non-SMCs. For SMC, earlier the cutoff for turnover was 50 crores, and for borrowing it was 10 crores. They have increased the cap from 50 crores to 250 crores as far as turnover is concerned, and for borrowings it is from 10 crores to 50 crores. So that is the only major change I could see in this entire Companies Act 2000, Companies Accounting Standard Rules 2021. Now, let's answer the fourth question. So we have understood what are the implications if accounting standards and standards and auditing are not complied with. As far as the companies, we have understood, as far as the auditors, for not complying with standards and auditing, there could be a disciplinary proceeding. And especially if there is a fraud, the Companies Act also will take into picture. So disciplinary proceeding if there has been a gross negligence with respect to the performance of the duties of the auditor, either in not bringing out the non-compliance with accounting standards or not following the standards on audit. Now the fourth question, how many accounting standards are there in India? Although on the face of it, this looks like a very silly question, let me answer it in a different way. How many accounting standards are there in India? In India, we have at least 4 accounting standards, 4 sets of accounting standards. Now, what do I mean by that? It depends whether you are a company or a non-company. If you are a non-company, then you have the accounting standards as prescribed by the Institute of Chartered Accountants of India. For a non-company, the accounting standards means accounting standards of the Institute of Chartered Accountants of India, which has to be complied not by the company directly, but indirectly, it has to be complied by the non-company. Otherwise, the auditor of such a non-company will bring about a qualification in the audit report regarding the non-compliance. So, for a non-company, what has to be complied is, even including an LLP, till now, for an LLP, the accounting standards of the Institute of Chartered Accountants of India only has to be complied. There is a the Llp Amendment Act 2021, which is coming out, which has already been cleared in the Rajya Sabha. We are waiting for the president to give his assent. After that particular thing, very interestingly, they have brought in a section very similar to section 133, wherein they have told that every LLP has to comply with accounting standards, and such an auditor of a company has to follow a standard, LLP has to follow standards on auditing. So what does the accounting standard mean for an LLP after that amendment happens is the accounting standards as available in the Companies Accounting Standard Rules 2021. So that could be the basis which will come out. So for an LLP, till now, for financial year 2021, we have to follow the accounting standards of the Institute of Chartered Accountants of India. So for non-companies, we have understood. For companies are classified into 2 types. One is, it could be a company which is a class company or other than a class company. If it is a class company, then such a company has to comply with Ind AS. For all other companies which are not class companies, they have to follow regular accounting standards. When I say regular accounting standards as prescribed under Companies Accounting Standard Rules 2006 for financial year 2021 and Companies Accounting Standard Rules 2021 from financial year 21-22 onwards. Now, what do you mean by class company? Class companies are those which are listed or in the process of listing or whose net worth is more than 250 crores. So they become the primary, and along with them, they take over all their bogies, which are described as associates, holding companies, joint ventures, and subsidiaries. So not only the entity which is actually having a net worth of more than 250 crores or is a listed entity, but all other entities or companies. It could be a non-company also, mind you. It could be a non-company also. For a non-company also, Ind AS could be applicable if such a non-company or a company happens to be a subsidiary, an associate, a joint venture, or a holding of such a company, which is primarily required to prepare Ind AS. What is the reason for such bogies to prepare under Ind AS? That is because eventually they also have to prepare a consolidated financial statement. If for one company it is under Ind AS and for other companies it is under accounting standards of the rules 2006 and of the Institute of Chartered Accountants of India, it will be difficult for it to be consolidated. So the logic is, for enabling it for easier and better consolidation, all the people associated with such a company will also have to prepare under Ind AS. So how many accounting standards are there? There are 3 sets of accounting standards, just now what we saw. To add to the confusion, we have a 4th set of accounting standards coming in as ICDS, which is applicable only for the limited purpose of income tax computation. Only for income computation. That is, as the name itself suggests, it is not for, if an entity says that I am complying with ICDS and I don't want to follow the Institute of Chartered Accountants of India's accounting standards, is it okay? The answer is no, certainly no. ICDS is only for the limited purpose of, it is a computational standard. It is a standard for controlling the computation of total income. That's it. It is not for the preparation of the financial statement. For the purpose of financial statement, even for a non-company, what has to be followed is the accounting standards of the Institute of Chartered Accountants of India. So that way we have 4 sets of accounting standards. But the very interesting thing is, for a particular entity, any one of the 3 standards will apply depending on what category of entity you are. And along with that, the ICDS will also apply. So that is a point to be noted. So how many accounting standards are there? By numbers, of course, today I'm not getting into the details of how many accounting standards. All of us know there are 29 accounting standards as far as the the companies which are not coming under Ind AS. For them, they have to follow, or for non-companies, there are 29 accounting standards by numbers. But if you look into accounting standard 6, very interestingly, accounting standard 6 dealing with the depreciation has been depreciated. And I always keep telling this in a very jocular manner, that accounting standard 6 dealing with depreciation has been depreciated. But on a serious note, the elements of accounting standard 6 has been imbibed in accounting standard 10, property, plant and equipment. Today, property, plant and equipment not only deals with how a fixed asset or a property, plant and equipment has to be brought into the books of accounts, how it should be disclosed, and what should be the value at the time of initial recognition and subsequent recognition. It also talks about how the property, plant and equipment has to be depreciated. So the elements of accounting standard 6 has been brought inside accounting standard 10 in the very similar manner like accounting standard 26. Today, dealing with intangible assets, not only deals with intangible assets, it also deals with amortization. Accounting standard 8, again on a jocular basis, we can say accounting standard 8, after much research and development, the institute has brought in the elements of R&D within accounting standard 26. It is not as though R&D expenditure is not told anywhere in the standard. How to deal with R&D expenditure is told within accounting standard 26 on intangible assets. Now, this particular slide shows 29 accounting standards. However, for a company which is a small and medium company, which we just now saw, a small and medium company, for them, 2 standards are totally exempt. One is accounting standard 3 on cash flow statement and accounting standard 17 segment reporting. So this will not be required by such a small and medium company to come out with that. So eventually they will have 29 minus 2, anyway 27. So from 27, if you remove 2, you will have 25 standards for a small and medium company. For such a small and medium company, there are relaxations given with respect to AS 15 on employee benefits. There are certain relaxations which I will not get into the details today. On leases, they have been given certain relaxations. Earning per share, a small and medium company need to show only a basic earning per share and a diluted earning per share need not be shown. Impairment of assets, there has been certain relaxations for a small and medium company. And there has been certain disclosure relaxation on accounting standard 29 for a small and medium company. So otherwise, these standards are applicable to all the entities in that sense. So I will not get into this today. But one very interesting point to be noted before we move out to the next question is, there has been a change for non-companies. For non-companies, all these years, we had three levels. And the present accounting standards board, has brought about on 1st of April 2020, they introduced to make it fall in line with the micro, small and medium enterprise. Today under the MSME Act, you have 4 classifications. There could be a micro entity, a small entity, a micro, small, medium and a large entity. So there can be 4 types of business entity under the micro, small and medium act. So to bring about the semblance of this, our institute in the Accounting Standards Board, they thought about that we will also have, instead of 3 levels for non-corporates, we will have 4 levels. We will have 4 levels for non-corporates. So accordingly, for financial year 2021, I repeat, for financial year 2021, whose financial statements we are signing now, this is already made applicable. The non-corporate entities will be categorized under 4 different 4 different levels, as against 3 levels which we were following until financial year 1920. Although this particular notification from the institute came out from the Accounting Standards Board on 1/4/2020, on 1/4/2021. The revised classification is made applicable with effect from 1/4/2020, that is financial year 2021. So what are the changes? As you can see here, the level 1 was earlier 50 crores turnover or borrowing of 10 crores. Any one of them breaching. I'm sure all of you know by now. Any one of them breaching, for example, if my turnover is 40 crores, but my borrowing was 12 crores. Until 1920, I used to call it as a level 1 entity. Now that 50 and 10 crore has been increased to 250 and 50. When looking into our institute's proactiveness, in fact, this particular change, what we just now saw in the Companies Accounting Standard Rules 2021, this particular revised change happened by the institute, considering the institute's proactiveness for financial, whereas our institute's change is for the financial year 2021, but the Companies Accounting Standard Rules 2021, which has changed the criteria, is applicable for the current year, which is going to be audited next year. That means for financial year 21-22 onwards, the revised criteria will be applicable for companies. For non-companies, what is the change? Level 1 is anything with a turnover of more than 250 crores or a borrowing of more than 50 crores, or if such a non-company happens to be a listed entity, a bank, financial institution, insurance, or a holding or a subsidiary covered otherwise under level 1. If you are an entity which is probably level 4, but you happen to be a subsidiary of an entity which is otherwise a level 1 entity, then such a entity which was otherwise level 4 will also have to follow level 1, will also have to be categorized as level 1 entity. So what is a level 2 entity? Any entity whose turnover is 50 to 250 crores or with a borrowing from 10 to 50 crores and other criteria is if it happens to be a holding or a subsidiary covered under level 2. Similarly, what is a level 3 entity? If its turnover is 10 to 50 crores, if its turnover is from 10 to 50 crores or a borrowing of 2 to 10 crores and the other criteria is it's a holding or a subsidiary covered under level 3. And for level 4, it is the residuary section, which is if your turnover is up to 10 crores or your borrowing is up to 2 crores, then you fall under level 4. Now, how do you see this particular level? If it is falling in any one or more criteria, as you could see. Now, is it applicable for every non-corporate entity? Let us say, is it applicable to Tirupati temple? Is it applicable to Tirupati temple? Is it applicable to a charitable or trust? Is it applicable to a temple or an entity which is just taking charity and doing charity? The answer is given in the standard itself. It says if the entity is engaged in commercial, industrial, or business activity. You check up this particular question. Is the entity engaged in commercial, industrial, or business activity? Any part of that particular entity, if it is having a commercial, industrial, or business activity, then for such an entity, all the accounting standards will be applicable depending on the levels. Depending on the levels, certain exemptions have been given, but accounting standards will be applicable. So the question is, for a charitable organization which receives charity and gives charity, then there is no commercial, industrial, or business activity. So therefore, for such an entity, accounting standards will not be applicable. Now, how will you look at the turnover? Turnover is in the previous year, in the immediate preceding accounting year. That is what you will look into. For when you are doing the audit of 2021, when you're doing the audit of 2021, you will look into the turnover of 1920 to determine whether it is a level 1, 2, 3, or 4. Similarly, when it comes to borrowing, at any time during the previous year, at any time during the immediate preceding accounting year. Again, when we talk about 50 crores, in financial year 2021, the borrowings could have gone beyond 50 crores. Could have gone beyond 50 crores. But I will not, and the turnover is, let us say, I don't look into the turnover of 2021, but I will look into 1920. If in 1920, if the turnover was, let us say, 200 crores and the borrowing was 40 crores, I will call it as a level 2 entity. Although in 2021 itself, it could have breached 250 crores or 50 crores of borrowing. So I will look into the previous year's turnover to determine what should be the classification for the current year. Now, figures in the bracket are earlier criteria, which we have already seen. Not applicable to non-corporates, required to follow IND AS. So we have already seen this. So what are the exemptions available? Let's get into the exemptions which are available to. What happens if you are a level 2, 3, 4? One thing we have to note is, if you are a level 1 entity and your turnover, either your turnover is more than 250 crores or your borrowing is more than 50 crores, then you have to comply with all accounting standards. All the 27 accounting standards will be applicable to you. However, if you happen to be a level 2, level 3, level 4, full exemption is given to accounting standard 3, cash flow, accounting standard 17, segment reporting, accounting standard 20, earning per share, 21, 23, and 27, dealing with consolidation, and 25, interim financial statements. So you don't have to prepare these, don't have to comply for 2, 3, and 4. If you are a 3 and 4, level 3 and 4, additionally, accounting standard 18 on related party transactions and accounting standard 24 on discontinuing operations need not be complied with. If you are a level 4 entity, you don't have to comply with accounting standard 14 on amalgamation and accounting standard 28 on impairment. And there are certain partial exemptions also available with respect to accounting standard 15 for level 2, 3, and 4 entities. I will just talk about that in the next slide. For level 4, very interestingly, if you're a level 4 entity, accounting standard 22, dealing with accounting for taxes on income, only to the extent of provision for current tax is what has to be dealt with for level 4. You don't have to deal with the provision for deferred tax in a level 4 entity. Very interestingly, a level 4 entity, most of our non-corporates will have a turnover of up to 10 crores or a borrowing of up to 2 crores. So for all such entity, maybe your own entity and my own entity also, we will fall under level 4 entity as far as our chartered accountants firm is concerned. So in that context, we don't have to compute provision for deferred taxes. There are certain disclosure relaxations given for level 2, 3, 4 entities. Accounting standard 19 dealing with the leases and accounting standard 29 dealing with the provisions, contingent assets and contingent liabilities. There are certain disclosure requirements only. The recognition criteria has to be there, but only disclosure requirements, there has been certain relaxation. Level 3 and 4, additionally, accounting standard 10 and accounting standard 11, certain disclosure requirements are exempt. For a level 4 entity, accounting standard 13 on investments and accounting standard 26 on intangibles, there are additional disclosure relaxations provided. Now, an accounting standard 15, let me tell you, because this is slightly confusing. Accounting standard 15, there has been, what is an accounting standard 15? Dealing with employee benefits. Employee benefits can be of 4 types. I mean, I always keep telling this. Employee benefits can be of four types. What has to be paid in the next 12 months to the employee, from the next 12 months till he retires, at the time of retirement, at the time of termination, and the post-employment. So these are the 4 types of employee benefits which we always say. What we pay in the next 12 months is called short-term employee benefits. What we pay, the other 3 types are called long-term employee benefits. Within the long-term employee benefits, what you pay after the retirement is called post-employment benefits. What you pay at the time of now, when it comes to short-term employee benefits, we don't have a problem when it has to be accounted on accrual basis. But for all long-term employee benefits, we have a big I have promised to the employee, if there is a actuarial risk, actuarial gain or a loss, who will bear it? Who will bear it? If I give it to an external agency and if that particular entity bears the actuarial risk and pays to the employee whatever has been promised as the terms of employment, then that is called as a defined contribution plan. Defined contribution plan. The best example is a provident fund. I give it to the provident fund, external provident fund agencies. So he will in turn pay whatever is required under the provident fund, the scheme, to the employee. So therefore I contribute and it is done. Defined contribution plan is the easiest. When it comes to defined benefit plan, what is a defined benefit plan? Where the actuarial risk is on the enterprise which has employed the employee. That means whatever lot of exercise, take the help of an actuary and find out what is the actual amount that I have to debit during this year so that I will earn as much to pay the employee as much as I promised in future. And there are various methods. I mean, one of the methods which is told by Accounting Standard 15 is that the employee benefit, whatever has been promised, it has to be accounted during the terms of his employment and not at the time of payment. That is the first thing. Second thing, what has been told is you cannot make it on a straight line basis. It has to be on a project unit credit method. What is a project unit credit method? As you can see here, at the beginning, it will be lower debit to the profit and loss account. And at the end, as the employee matures, he will be giving more back to the organization. So therefore, the debit on account of that particular employee should be more at the time of his later part of his employment. So a shorter debit to the employee on account of employee cost, on account of long-term employee benefits, defined benefit plan. Smaller at the beginning, like in a project unit credit projector. You think of a unit, a film projector, where it's the projector starts with a small ray and then goes on to become a 70 mm. So in that fashion, the smaller debit at the beginning and a higher debit at the end of the employee's term life. So that will be the debit. Now the point that is to be noted is how it is to be calculated, who has to do it. It all happens based on the actuary. So there has been certain relaxation given to level 2 and 3 entities. Within level 2 and 3 entities and SMCs, they have categorized it as employees with less than 50 employees and otherwise. So let us read what the exemptions are. For level 1 enterprise and for all companies except a small and medium companies, Accounting Standard 15 has to be followed in total. For level 2 and 3 enterprises, if the average number of employees during the year is more than 50, and to small and medium companies, for all small and medium companies, for small and medium companies, there is no 50 employee criteria. Only for non-companies, that too for level 2 and level 3. If a level 1 enterprise has less than 50 employees, you still have to comply with AS 15 in totality. For a level 2 and level 3 enterprise, if the number of employees employed is less than 50 and to all SMCs, Accounting Standard 15 is applicable except provisions relating to recognition, measurement, presentation, and disclosure in respect of defined benefit plan for post-employment. We saw that for post-employment and other long-term employee benefit, but they should use actuarial method to measure. So there has been, they have to follow Accounting Standard 15 in totality. However, an exception has been given for working out defined benefit plan the regular principles as told in Accounting Standard 15 with respect to defined benefit plan for actuarial valuation, etc., need not be complied with. But what they have to do is they have to use an actuarial method to measure and recognize accrued liability, adopting a PUCM method. They need not employ an actuary, but they have to follow the actuarial method on their own, considering discount rate determined by reference to the market yields at the balance sheet date on the government bonds, and disclose the actuarial assumptions. Now, as per the second point, recognition and measurement of short-term accumulated compensated absences, which are non-vesting, you don't have to comply. Discounting amounts payable after 12 months of the balance sheet with respect to defined contribution plan and termination benefits also need not be complied with by the B category. Now, what is the C category? Level 2 and 3 enterprises, if the average number of employees during the year is less than 50, and level 4 enterprise. So all level 4 enterprises and level 2 and level 3 enterprises with less than 50 employees, additional relaxations. Apart from B category relaxations, additional relaxations have been given to them. What is that? Recognize and measure liability and expense regarding defined benefit plan for post-employment and other long-term employee benefit with respect to some other rational method. They need not follow the project unit credit method also. Any rational method is okay. So a method such as all the employees, I'm accounting the retirement benefits as, let us say, gratuity, assuming that all of them retire on the balance sheet date. So that could be a method. So that is how I can calculate if I am a level 2, level 3 enterprise with less than 50 or a level 4 enterprise. Accordingly, there is no requirement of any disclosure, including actuarial assumption. So please note, if you are a level 4 enterprise, even if the number of employees is more than 50, you still fall under the C category. So that is how the Accounting Standard 15 is built up. Question number 5. How will the non-compliance of accounting standards and standards on auditing be known? Please understand, the auditor is not I always keep telling this, your client is not your boss and auditor is not the final authority. Please understand this. Although the client pays you the money, he is paying you the fee, not the salary. So therefore, you cannot call the client as a boss. He is only a client. And as the auditor, I am not the final authority. So there can be a peer review. Today, we are sitting on the peer review board. Through the peer review board, one can find out whether there have been non-compliance with accounting standards on auditing. However, there is a specific board in our institute called the Financial Reporting Review Board, which goes on to find out if there is any non-compliance with respect to some technical requirements. Technical requirements means the standards on accounting or the standards on auditing. Similarly, there could be a technical scrutiny from the Ministry of Corporate Affairs. The Register of Companies can take up the financial statements for technical scrutiny, and in the process, if there are any non-compliances observed, the company as well as the chartered accountant will be taken to task. So how will the non-compliance of accounting standards and standards on auditing be known? One is through the FRRB mechanism. One is through the technical scrutiny of the from the Register of Companies. And what are the normal non-compliances observed in accounting standards? So here, let me just, I will not be able to get into the gamut of it. Otherwise, that's a big session itself. For every standard, we can tell what are the various non-compliances that have been observed. But let me just tell you what the Financial Reporting Review Board of the Institute does. What is the Financial Reporting Review Board? It is a board like the peer review board. It picks up balance sheet either based on complaints or on CO motor basis, and sends the balance sheet to a particular chartered accountant called the technical reviewer, and that particular reviewer reviews the financial statement for non-compliances with respect to accounting standards or standards on auditing. He pinpoints and sends it back to the FRRB. FRRB in turn sends such of the non-compliances to a group of chartered accountants consisting of 4 senior chartered accountants, who will sit in judgment to find out whether those non-compliances which have been told by the technical reviewer are in fact correct, which are pointed out, or whether they are correctly pointed out, the mistakes. And in addition, they can also add on to the additional non-compliance, because financial statements are given to them. They can also add on additional non-compliances observed and give it back to the board. The board finally reviews and finds out whether there are real non-compliances, and once they observe that there are non-compliances, for material non-compliances which affects the true and fair view of the financial statements, the case will be referred to director discipline, unlike in the case of the peer review board, which is only a hand-holding, as Diane was talking about. It is only a hand-holding exercise to improve the quality of the profession. This particular thing is not a hand-holding exercise. It is a trigger. I mean, it will be going to the, after a show cause notice is issued to the member, it will be referred to the director discipline for initiating appropriate action against the auditor. However, if the non-compliance is of a non-technical, I mean, it's only technical and not affecting the true and fair view, Financial Reporting Review Board issues advisory to the auditor. It issues a letter saying that next time please don't commit such a mistake. And FRRB also informs the peer review board. So there is a talk between the FRRB and the peer review board about the advisory letters issued, so that it may accordingly be considered during the peer review. And from the Financial Reporting Review Board, these non-compliances will also be intimated to the concerned regulator, such as the MCA or RBI, SEBI, IRADA, so that necessary action can be taken against the companies. Similar thing will happen when a technical scrutiny happens on the company. The information will flow from the regulator to the Institute of Chartered Accountants of India to take necessary action against the chartered accountant concerned. Now, the Financial Reporting Review Board has come out with various, has come out with volumes of books. For the moment, some 4 or 5 books have come out from the Financial Reporting Review Board, listing out what are the various non-compliances with respect to various standards on auditing or accounting standards. So they have given a pictorial representation, not only in terms of this bar chart, with respect to each standard, which paragraph has not been complied with mostly is also pictorially represented. So here I will take up a few non-compliances with respect to Accounting Standard 1, because Accounting Standard 1 is like, I would say, SA 700 or 705, 706, because SA 700 is actually coming out with the audit report. Now, for accounting standards, all the accounting policies, significant accounting policies have to be disclosed. So if I say SA 700, 705, 706 is the mother of all standards on auditing, for our accounting standard, which is the most important accounting standards, means Accounting Standard 1. So I'll just pick up and tell you what are the various non-compliances observed in the process. Now, Accounting Standard 1 deals with disclosure of accounting policies. What is expected is you have to disclose not all accounting policies, but you shall disclose all significant accounting policies. Disclose all significant accounting policies at one place. And such a disclosure which you make in the financial statement will not make a mistake. I mean, if you disclose that I have followed a LIFO method of inventory valuation, whereas what Accounting Standard 2 permits only FIFO and weighted average method, but you have followed a LIFO method of inventory valuation, but you have disclosed. A disclosure of a mistake will not make the mistake no mistake. A very important point to be noted is you cannot disclose that I have followed a wrong accounting policy, a policy which is not as per the standard, but I have disclosed. But this disclosure will not absolve you of the punishment which can be given to you for not following the accounting standards. So then, I have just categorized the non-compliances of Accounting Standard 1 under 3 headings: inadequate disclosures, incorrect disclosures, and other lapses or excessive disclosures. Now, inadequate disclosures. Now, point number 1, revenue. When you see this, and you will find out what the mistakes are, you will have to be very, very careful in drafting the accounting policies. In earlier days, we used to take Infosys balance sheet, Reliance balance sheet, Tata's balance sheet, and used to prepare the accounting policies looking into their balance sheet. But today, if I am following an accounting standards and I am trying to copy the accounting policy of Reliance or Infosys, then I am making a bigger blunder because they are following Ind AS and I am following accounting standards. So it becomes very important now that my framing should be my entity specific and year specific also. It cannot be, I cannot copy from somebody, or I cannot copy the same accounting policies throughout the period when it is not there. When an item, let us say this year, there was no inventory at all. But I should not therefore give an accounting policy on inventory recognition. So it should be year specific. Similarly, if there were no dividends until last year, but this year I have made an investment, and the inflow on account of dividends is substantial, then I have to give a disclosure of accounting policy with respect to how I have recognized the dividend income. So I cannot just copy and paste from the, so it has to be year specific and entity specific. Inadequate disclosure. Point number one. Revenue includes revenue from sale of goods, maintenance services, and interest income. Now, if somebody has just told includes revenue from sale of goods, moment I have sold, I am not interested in knowing. Definitely, I know this. When did you recognize the sale of goods is what I want to know. So here I should say sale of products is recognized when significant risks and rewards of ownership of the products are passed on to the customers or when the service has been provided. Sales are stated at contractual realizable values, net of GST and trade discounts. So this is how the entire accounting policy disclosure has to happen. Please understand, I cannot prepare my accounting policy in a very, very casual manner. It is a very, very serious document which I have to place it, which could be subject to technical scrutiny. So therefore, be very, very cautious when you are framing the accounting policy or when you are disclosing the accounting policy. Point number two, entity's dividend income was more than 50% of the total income, but separate accounting policy with respect to dividend income is not made. I already mentioned this. When there is a significant source of revenue, you shall disclose the accounting policy with respect to that particular revenue. Investments are valued at lower of cost or fair value. Now, again, terminologies are everything in accounting standards. If you use a wrong terminology, it gives a totally wrong meaning. You could have done the right accounting, but if your disclosure of policy is wrong, using a wrong terminology, then you are caught LBW, I will say. It is a situation of LBW. So I would say, what is the mistake here? Investments are valued. Accounting standard 13 goes on to say that there are three types of investments: current investments, long-term investments, and investment properties. Current investments are always measured at cost or fair value, whichever is lower. Cost or fair value, whichever is lower. Long-term investments are valued at cost unless there is a decline for reasons other than temporary. Investment properties are valued as per accounting standard 10 using the cost model. So this is how the what is investment property? Investment properties are of three types. They could be properties held for sale, properties held for own use, or investment property. So properties held for sale is inventory as per AS2. Properties held for own use is as per AS10. And property other than for sale, other than for own use, it could be for capital appreciation or for earning rentals, in which case it will be valued as per accounting standard 13 and the investment property. Investment property has to be valued using the cost model of AS10, which means valued at cost less accumulated depreciation, less accumulated impairments. So you cannot use revaluation model for investment property, or you cannot use at cost alone. You will have to depreciate even our investment property. Having said that, what is the mistake here? Investments are valued at lower of cost or fair value. You will have to point that the current investments are valued at lower of cost or fair value. You cannot just say investments are valued. Long-term investments have to be valued at cost. Unless there is a drop, unless there is a decline in value for reasons other than temporary. You look at the next question, next point. Long-term investments are carried at cost. However, provision for diminution in value is made to recognize any permanent decline in the value of investments. When I told you, the standard uses the word, standard does not use the word permanent. When I always ask this question, if it were to be a face-to-face session, what is the opposite of temporary? What is the opposite of temporary? It is, in the normal language, it is permanent. But in the accounting standard language, it is other than temporary. That means there is a temporary, there is an other than temporary, then there is a permanent. If I have invested in shares of a particular company at 100 rupees, and today it is valued at 60 rupees, it is valued at 60 rupees because for consistently the shares are being traded at 60 rupees. If I am keeping in my books as 100 rupees, it is a long-term investment, then I am not following the accounting standard 13. for reasons other than temporary, that means for almost 4 years, it is hovering around 60 rupees. I have to bring down my investments at 60 rupees. If the standard had used the word permanent, then the decline in permanent happens only when I sell the investment or when the other company goes in for liquidation. So therefore, they have very carefully worded saying that temporary, other than temporary, permanent. So permanent is a higher stage. Other than temporary is an in-between stage. So the moment you reach an in-between stage, you should account for such an impairment of or the loss in the value of the investment. So it is sooner than permanent is other than temporary. So you cannot use the word, if you use the word any permanent decline, that amounts to a great mistake. Incorrect disclosure. Borrowing costs are capitalized if capitalization criteria is met. Very inadequate disclosure. I mean, I cannot just say borrowing costs are capitalized as per accounting standard 16. That could have been an easier way, just like what has been told in point number 7. DTA, DTL has been provided in the books of accounts as per AS 22 of the Institute of Chartered Accountants of India. Now, one has to be able to read and understand by himself without reading the technical literature. Borrowing costs are capitalized with respect to qualifying asset. And then I have to say, what is a qualifying asset? A qualifying asset is an asset which takes substantial period of time for its completion to sell or completion to produce. Now, borrowing costs, point number 6. Borrowing costs relating to acquisition of fixed assets are also included to the extent they relate to the period till such assets are ready to be put to use. Again, what is the mechanism of capitalizing the borrowing cost? Borrowing costs relating to acquisition of fixed assets are also included to the extent they relate to the period till such assets are ready to be put to use. Not all fixed assets borrowing costs can be capitalized. Only those fixed assets, or today it's called property, plant and equipment, or for that matter, even for the inventory, you can capitalize the borrowing cost. You can capitalize the borrowing cost if it happens to be a qualifying asset. Let us say I have borrowed 10 crores for constructing a building, and that building is getting over in 6 months' time. Then accounting standard 16 says that the cost of the borrowing, interest of this 10 crores, has to be debited to the profit and loss account, and it cannot be capitalized. The first criteria for capitalization is the asset for which you have taken the loan should be a qualifying asset, which means it should be taking more than 12 months for it to be completed. However, ICDS and section 36 of the Income Tax Act says any asset, even though it is not a qualifying asset, I mean, until it is put to use, you will have to capitalize. For income tax purpose, you will have to capitalize it. But for accounting standard purpose, you will have to debit it to your profit and loss account. The interest which you debited to your profit and loss account has to be added back to your income for income tax purpose. And that interest may be added to the fixed assets block in the income tax depreciation schedule. So what is the mistake here? Borrowing costs relating to acquisition of fixed asset is wrong. It should have said acquisition of a qualifying asset. So point number 7 we have already seen. Point number 9, other lapses, excessive disclosures. If an entity which does not receive any subsidy discloses accounting policies for subsidy, it will be misdirecting. I have no subsidies at all received in the last year. Maybe 5 years ago I had some subsidy, but today also I'm disclosing that. That is wrong. There is no subsidy. Where due to the nature of the business, the entity has no inventory, but it discloses accounting policies for inventory. This is also considered to be an excessive disclosure. Beware or watch out for trade receivable balances are subject to reconciliations and confirmations. Now, if something like this is told, it is as good as telling that I have audited the financial statements, and there is a note within the financial statement which says trade receivable balances are subject to audit. I mean, it's as worst as failing like that. So are subject to reconciliations and obtaining confirmations are part of the audit process. Only after I obtain that and I am, as an auditor, I have satisfied myself, will I give an audit report. If it is already audited and a clean report is given, and the financial statement consists of such a statement that trade receivable balances are subject to reconciliation and confirmation, and if the trade receivable happens to be a material figure, then it is a mistake. It is like giving and information which should have been otherwise there in the audit report is there in the financial statement. Wrong. Inventories as certified by the management. Inventories as certified by the management, or related party disclosures, related parties as certified by the management. This, if you are giving it in the financial statement, it is wrong. What is the reason why I am calling it as wrong? Because whatever has to be told by the management has to be told in the financial statements. Whatever is there in the financial statements is what has been told and certified by the management. Why should they say that inventories as certified by the management? Everything in the financial statement is certified by the management. It looks as though the auditor wants to absolve himself of this particular element of the financial statement. Therefore, he has told the management to say this, or the auditor has told that it has to be as certified by the management. And auditor has not carried out any process by himself to find out whether the inventory valuations is correct or presence is there, etc. So such a statement is misleading. Even our guidance note on audit of inventories says that such a statement should not be there in the financial statement. And if it is there, the Financial Reporting Review Board will point it out as a mistake. So related party disclosures also cannot be. Everything in the financial statement is certified. The financial statement is the responsibility of the management. We are telling that in the audit report. SS 700 says that. Now, whatever I want to say, I must say it in the audit report. We cannot crisscross the jurisdictions. The accounting policies must be distinct from other disclosure requirements. Yeah. In case of non-companies subject to tax audit or accounting standards applicable. The answer is an emphatic yes. Even a financial statement which is subject to tax audit, although it is going only to the income tax department, and you may say, I have followed the ICDS, which is required for the income tax department. I don't want to follow the accounting standards of the Institute of Chartered Accountants of India. The entity may say so. But as an auditor, it becomes my responsibility to bring about all the non-compliances with respect to accounting standards of the institute when I'm doing the attest function for such a tax audit entity. Should the previous year figures be given in the financial statement? Our institute, in the guidance note on tax audit, has made it recommendatory that a previous year figure should also be given in the financial statement. Mind you, I am underlining the word recommendatory. What additional disclosures are required to be given in the financial statements? In the financial statements, I have to give even for a non-corporate entity or a non-company entity, I have to disclose information mandated in the applicable accounting standards in the financial statement. So therefore, I will give method of accounting followed, whether accrual or cash, method of inventory of valuation, revenue recognition, property, plant and equipment, accounting standard 11, accounting standard 13, 15, 16, 18, 22, 29. All these I will have to give even for a non-corporate entity. Items that may require qualification in the audit report. And if it is not there in the financial statement properly, then it requires a qualification in the audit report. Non-compliances of mandatory accounting standards such as non-provision of income tax. For level 4, deferred taxes are exempt. But for all other entities, even deferred taxes have to be calculated. Employee benefit, especially retirement benefits. Confirmation for balances. I mean, if confirmation of the balance is subject to confirmation means I'll have to that extent, if it is material, give a disclaimer in my main audit report. So to that extent, it is serious. So never use notes on accounts for audit qualifications. I think Subodh Kumar Agarwalji rightly said that financial statement notes cannot be a semblance or cannot be a substitute for the qualification in the main audit report. We go to the next question. Whether accounting standards for non-companies apply if such an entity is following cash method of accounting. Now, this is a very interesting question. I'm following cash method of accounting. Does accounting standards apply to me? When you think about it, the answer is yes. Even if you are following cash, ICDS, very interestingly, ICDS is not applicable to an entity following cash method of accounting, but accounting standards will apply even if the entity follows cash method of accounting. Now, however, there are certain very interesting exemptions which are not there in the standards, which automatically stands as exemption because they're following the cash method of accounting. For example, how do you follow accounting standard 7, percentage of completion method, when you are following the cash method? How do you follow accounting standard 9, revenue recognition on accrual basis? May not apply. Accounting standard 15, or whatever we spoke about, other long-term employee benefits, etc. You are following cash method, so will not apply to AS 15, may not apply. AS 22, provision for taxes, provision for deferred taxes, may also not apply. Whatever has been paid has been expensed, whatever has been received has been taken it back. So accounting standard 29 on provisions, contingent assets and contingent liability also may not apply, especially provisions. Maybe contingent assets, contingent liability disclosure may be required even for a cash method of accounting. So our institute has to really come out with the literature on how for a non-company, what are all the standards which are otherwise not applicable. Now, very interestingly, a question came out. How do you account? Accounting standard 2. How to account for inventories when purchase itself is not accounted? Now, we could have a situation where the goods have come in, but since I have not paid for it, I am not accounting for the creditor. I have not accounted for the creditor, but the goods have already come in. So purchase is not accounted. Do I have to account the inventory? The answer is no. What has not been taken to the left side of the balance sheet cannot come into the right side of the balance sheet. So follow the simple approach of left, right. Question number 8. Tax audit report requires matters in Form 3CD to be certified as true and correct. Should the tax auditor give an absolute assurance as against a reasonable assurance given in the standards on audit, wherein the auditor certifies financial statements as true and fair? So in our normal audit report for a company which we give under SA 700, we say it is financial statements reflect true and fair. Whereas 3CD information is mentioned as true and correct. Does it mean that for financial statements I give true and fair, and true if remove, here it is correct means absolutely correct, and fair means more or less it is correct. Now let us be very clear that our standards on auditing, we have got only 2 types of assurances. One is a reasonable assurance and the other one is called a limited assurance. For our financial statements, when we prepare the company's audit report, SA 700 and all, we give a reasonable assurance. There is no such thing as absolute assurance. Please understand very clearly. When you are doing a certification, there is a difference between a report and a certificate. When I am giving a certificate, turnover certificate, or an income certificate, then it is a matter of absolute assurance. I mean, this is to certify that this is the income as per so and so document. But the financial statement as a whole, or for that matter, even for 3CD, I have to say that there is no such thing as absolute assurance, because audit has an inherent risk. I cannot be 100% sure, even if I've done 100% watching. So therefore, there is no such thing as absolute assurance. It is only reasonable assurance or limited assurance. So even in the case of 3CD, although I use the word true and correct, it is only a reasonable assurance that I am giving to the department. Just like in the case of a statutory audit, where I am giving true and fair view, there also it is reasonable assurance. So framework of assurance engagement talks about 2 types of assurance engagements, which is reasonable assurance and limited assurance. So what is a limited assurance? Limited assurance is what we do when we do for the limited review, where we give a negative form of an expression of opinion. And SA 200, the overall objective of independent auditor and the conduct of audit in accordance with standards on auditing, which is the name of the standard. Auditor to obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether due to fraud or error. Okay? So reasonable assurance, a high but not absolute level of assurance. It's a high but not absolute level of assurance. Please understand, as auditors, we cannot give absolute assurance to anybody. Okay? What is a reasonable assurance, etc. has been defined. I go to the next question. Can test checks be used for giving details in Form 3CD in cases of huge volume of transactions, especially with respect to 40A3, 269 SST, TDS reporting under clause 34 of 3CD regarding TDS and TCS? This is a question which, if you see that it is true and correct, then you cannot do trust check. Everything has to be pointed out. But our institute in the guidance note, keeping this aspect of reasonable assurance, keeping this aspect of inherent risk in the process of audit, has permitted test checks to be done subject to certain conditions. Now, what are those conditions? The TDS compliances under clause 34. Our guidance note says, for voluminous transactions, if there are far and few transactions, you do 100%. But think of a big bazaar or Reliance or a very big entity where every day there are 1,000 transactions where TDS has to be happening. Is it physically possible for an auditor to check every transaction? It's a voluminous transaction. So therefore, test checks and compliance tests can be done. But primary, then where is the question of true and correct? Where is the question of true and correct? Please understand that it is the responsibility of the management to say it is true and correct. Management has to fill in the form 3CD. They have to fill in the form 3CD truly and correctly and give it to the auditor. The auditor will do his process and also certify that it is true and correct, and say that primary responsibility to fill information is that of the assessee, which is confirmed through a management representation letter. Tax auditor must ensure that no item is omitted in the information provided to him. He should ensure that everything has been properly filled up. Indicate extent of test check in audit working papers. Tomorrow in the audit working papers, I have to say how I have selected the samples and what is the nature of test checks that I have done. Tax auditor can apply materiality and audit sampling technique as per SA 530. So this is what is told. Based on effectiveness of internal control. Now, very important underlying thing is the auditor should be satisfied with the internal control aspects in the company. If he is not satisfied with the internal control, then that itself is a big risk. So if he is satisfied with the internal control and all other procedures, then he can do a test check. So for 40A3, 269SS, 269T and 269ST, our institute in the guidance note said 100% examination or testing must be done, because today the technology, if you're doing through a tally itself will tell you what are all the exceptions, payments more than 10,000 rupees cash. The MIS information will be thrown out by the system itself. Whereas the MIS information cannot be thrown out with respect to TDS. I always keep telling this, hey Alexa, tell me what are all the information, which are all the payments which have been paid more than 10,000 rupees, means it will tell me. If today, hey Alexa, tell me what are all the transactions on which TDS has not been done, means it will say, sorry, I don't understand the questions. So therefore, wherever Alexa or wherever the system can help you, there you should go in for the 100% watching. Wherever it is not possible, you can do the sample checking. Next question. How will the income tax department know that reasonable assurance is provided by complying with the standards on audit, even in the case of a tax audit report done by the tax auditor? Now, the question in the form 3CA or 3CB is very clear. The information provided in form 3CD is true and correct. And the information, the department thinks that what you are giving is correct, means 100% correct, means it's a sort of a certificate and not a report. And therefore, it is an absolute assurance. How, as an auditor, you are now, our institute says that you can follow test checks, sample checks, etc. But is there an expectation gap? Is there an expectation gap from the department and a delivery gap from the auditor? How are you going to bridge these expectation and delivery gaps? So there, our institute in the guidance note says, please, in form 3CA or 3CB, under clause 3 of 3CA or clause 5 of 3CB, you insert a SA 700 type of information within, and tell the department that I have done the audit following the standards on audit, and the standards on audit permits me to adopt sample test checks, etc. So, and also tell him that this particular information is filled in by the assessee. It is his responsibility to fill in this particular information. My responsibility is to verify using the principles of standards of auditing. So I will bring in this. Assessee's responsibility for financial statement and statement of particulars in form 3CD. I will say point number 1, assessee is responsible for preparation of the aforesaid financial statements. Point number 2, the assessee is also responsible for preparation of the statement of particulars required to be furnished in 44AB, that is 3CD. Then I will say tax auditor's responsibility. Our responsibility is to express an opinion on these financial statements based on our audit. We have conducted this audit in accordance with the standards on audit issued by ICAI. Those standards require that we comply with ethical requirements and plan and perform the audit to obtain reasonable assurance about whether the financial statements are free from material misstatement. Now, an audit involves, I will give what is an audit. I will also say we believe that the audit evidence we have obtained is sufficient. We are also responsible for verifying. We have conducted our verification of the statement in accordance with the guidance note on tax audit. Now, what is the framework based on which I have done my audit? One is standards on auditing. I have also considered my guidance note on tax audit under section 44AB, which in turn permits me to follow test checks and sample checks. The next question, how many standards on audit are there? Now, accounting standards, when I always say, Dayaji, that accounting standards and standards on auditing, accounting standards are like property, plant and equipment, tangible. Standards on auditing are like accounting standard 26, intangible. Now, the moment we ask how many accounting standards are there, at least everybody will say, make an attempt, 29 accounting standards, minus 2, 27. Now, how many standards on auditing are there becomes a very, very difficult answer for even a very seasoned chartered accountant to answer. So how many standards on auditing? First of all, are they all mandatory? Let us be very clear. All standards, the moment we say it is standard, it is mandatory. Like Daya was mentioning, even if you are doing the audit for free of cost, you cannot be subjective when you are using standards. It cannot be linked to the fee that you are collecting. Whether or not you take a fee, whether you take less fee or more fee, all standards have to be complied with. Okay. So guidance note, you have an option to not follow guidance note. There also we say, please be very careful, follow the guidance note to the brim, unless you have reasons which you can possibly justify as to why you are not following a guidance note. Even guidance note has the power of a standard itself. So whereas standard has to be followed in letter and spirit. So how many standards on auditing are there? Now, one has to answer this question in a very different way. If you look into the compendium of standards on auditing, it has auditing, reviewing, and other standards. So standards on auditing, we have 38 standards. Then review engagements, we have 2. Assurance engagements, we have 3. Review standards, related services, standards on related services, we have 2. And standards on quality control, which I am told is already done under the series of the 7-day series, the 7-session series, it's already done, SQC1. So in that, we have the compendium of standards on auditing, we have 46. But we have specifically 38 standards on auditing, which is blessed by the Companies Act, which we have already discussed. Now, which are all these 38 standards? Quickly, let me take you on to the most important ones today. The general principles and responsibilities. The standards are all series-based, number-based, which are all in different compartments. They are given in 6 different compartments. General principles and responsibilities. Yes, there are 9 standards. SA 200, overall objectives of the independent auditor and conduct of an audit in accordance with standards on auditing. The name of the standard itself is 2.5 meters. Now, SA 200, this is a very important standard. In fact, earlier it used to be called as basic principles governing an audit. When we were students of audit, of course, now we are practitioners of audit in that sense. Basic principles governing an audit. So they have now changed overall objectives of independent auditor. If there is one standard which you have to read and understand, then that is SA 200. SA 210, agreeing the terms of audit engagements. Obtain an audit engagement letter before you start the audit. Let there be very clear terms as to what you are going to do, what he is going to do. You are mutually agreeing to the jurisdictions, as we popularly called in the beginning, in the earlier part of the session. And in case there is any fraud or error which is noticed, which is material, what is the type of report that you will give, what is the fee, etc., will all be discussed in the engagement letter as told in SA 210. SA 230, documentation. I think last week you already had that. What is audit working papers? What are all the contents? How you should preserve it, etc., etc. Risk assessment and response to assessed risks. Very important. How do you carry out an audit? how do you carry out an audit, how do you plan and identify, plan the audit of financial statements, what are the various risk elements you will consider, SA 300, SA 315, audit evidence. In the file, what are the things that you are going to put by way of audit evidence? SA 500, SA 530, audit sampling. How did you choose your sampling? SA 517, going concern. How did you visualize whether the company is having a going concern, is the going concern at stake? SA 580, written representation. Finally, what will come into your file in support of the various what we call sufficient and appropriate audit evidence. So when we say sufficient and appropriate, sufficient is with respect to quantity, appropriate is with respect to quality. Whether sufficient quantity and appropriate quality of audit evidence have been taken into account. Then the fourth category is of using the work of others. There are 3 standards dealing with that. Using the work of others, other auditors, using the work of internal auditors, using the work of auditors, experts. That means other than the chartered accountants, valuation experts or anybody else, engineers, etc. How do you take that is what is told in using the work of others. Then we have 6 standards coming under audit, conclusion and reporting, the mother standards. SA 700, clean audit report, unmodified opinion when you are giving. SA 701, dealing with key audit matters applicable to listed entities. SA 705, modified opinion. When if at all you have to modify your opinion, which could be of 3 types. It could be either a qualification, it could be a disclaimer, or it could be a negative report. You are giving a negative report. It is not true and fair. So in that, these 3 types. SA 706, dealing with emphasis of matter or other matter paragraph. Emphasis of matter is a matter which is already there in the financial statement, which is properly dealt with, but is of such fundamental use to the reader that you as an auditor would like to re-emphasize that matter in your audit report under a separate paragraph called the emphasis of matter paragraph. Other matter paragraph is not a paragraph which whatever other matters you want to put there. It's not like that. SA 706 is very clear. Matters dealing with audit, you put it under, let us say, out of the 100 branches, 3 branches have been not audited because they are not significant. That is a matter which you have to bring it under other matter paragraph. Or in a consolidated financial statement, I will say that out of the 5 balance sheets, 3 balance sheets of the branch, other subsidiaries have been done by some other auditors. So that matter pertaining to the audit is what you will bring it under the other matter paragraph. Specialized areas, dealing with certain special purpose frameworks, elements of financial statements, summary financial statements. So these are all the broad standards, 38 standards. I will not be getting into the details of it today. But let me move quickly because I've got another 13 minutes. Let me try to finish off. What precautions must be taken while certifying the provisional financial statements and the projected financial statements? Provisional financial statements, that means the statements, the balance sheet, the financial statements has not been audited. Can I sign the financial statement? Can I just put a seal and say that is subject to audit? Please understand, no. You cannot just put a seal and signature. Earlier we used to do that. But now, with standards on review, standards on related services, standards on related services 4410, puts a stop to all this. It says, it gives us precautions under which I have to release a provisional financial statement. In fact, an auditor cannot just put a seal and signature even on the income tax return and say it is a certified true copy or as per original. An auditor is not a notary. Anything that he does should be supported by an audit report or a certificate. That is our institute's view. So a provisional financial statement, or if you are compiling the information, you should comply with the standards on related services 4410. Which says, if you are just putting a signature and stamp, then I'm saying that it will be leading to it will be misconstrued as having audited by him. Please understand, put a just seal and signature. If your association of name of a chartered accountant with such financial statement is not misconstrued by the users as having been audited by him. So what you have to do is, you will have to give an audit report. And you call it as not as an audit report, you call it as an accountant's report on compilation of unaudited financial statement. That should be the heading of the financial statement. On to whomsoever it may concern, on the basis of accounting. Normally, these compilation is done for the bankers. So we address it to the bankers only. On the basis of the accounting records and other information and explanation provided to us by the management, we have compiled the unaudited balance sheet of so-and-so as it's so-and-so. The management of the entity is responsible for etc., etc., etc. What is my job? The compilation engagement was carried out by us in accordance with the standards on related services 4410. Engagement to compile financial information issued by the Institute of Chartered Accountants of India. The balance sheet and the profit and loss account are in agreement with the books of account. We have not audited or reviewed these financial statements and accordingly expressed no opinion thereon. So we are only talking about the agreement with the books and we are not talking about with anything else. Now, what about, and please understand, whenever you are issuing a report like this, you should obtain a UDIN. You have to obtain a UDIN. Prospective financial statement and information. Comply with the, let us say a banker, somebody is preparing a project report and the banker says that you should give a seal and signature of your chartered accountant on this. Can I do that? Now that answer is given in SAE, Standards on Assurance Engagement 3400, where it is said CA is deemed to be guilty of professional misconduct if he engages in estimation of earnings contingent upon future transaction in a manner which may lead to believe that he vouches for the accuracy of the forecast. This is told in second schedule. So what should be done? ICAI Council has given a way out. CA can participate in preparation of the profit or financial forecasts and can review them provided he indicates clearly in his report which is the source of information, from where have I gathered, let us say, the total market size of this particular industry, so and so. From where did you get that particular market size? Okay. Basis of the forecast. Major assumptions made in arriving at the forecasts. And he does not watch for the accuracy of the forecast. So these are the elements which he has to keep in mind. And illustration has been given about the opinion, the manner in which the opinion on the projected financial statement can be given. Based on our examination of the evidence supporting the assumptions, nothing has come to our attention which causes us to believe that assumptions do not provide a reasonable basis for the forecast. Further, in our opinion, the forecast read with the notes thereon is properly prepared on the basis of the assumption as set out in note number so and so, and on a consistent basis with the historical financial statement using appropriate accounting principles. Actual results are likely to be different from the forecast since anticipated events might not occur as expected and the variation might be material. So we are trying all the how it has been done, what is the basis. It has been continuing based on the past practices and following the past principles, but we are also saying subject to market risk. I mean, the future may not be like the past. I mean, one of the important things on the provisional financial statement is some of the banks tell that the auditor should give a certificate or should give an undertaking that the provisional financial statements will not vary from the audited by more than 5 or 10%. Please don't give such an undertaking. Such an undertaking can at most be given by the company or the client or the preparers because they are confident that there will be no deviation. Assuming that an auditor gives that it will not be more than 10% variation, he gives an undertaking. Tomorrow when he actually does the audit, if it is varying by more than 10%, should he go by his previous undertaking or should he go by the reality? So there will be a very big dharma sankat there. So therefore, resist, and avoid. In fact, I have written letters to the bank and I was a director in the bank and I have told them that such a thing should not be taken. Even we have written to the IBA, Institute has write to the Indian Bankers Association or Reserve Bank of India that such a undertaking should not be asked. If somebody is asking, ask them to give it in writing and you write it to the bank, they will take such a manager to task. Quickly, what is the mandatory period for which the audit documentation must be retained? All of us know Income Tax Act says 6 years. Now, of course, 10 years because if your income escaping is more than 50 lakhs, then 10 years documents may also be called. But otherwise, it is 6 years. Companies Act says 8 years. But our accounting standard, SA 230, read with SQC 1, says an average of this 6 and 8 is 7. So 7 years from the date you sign the financial statements, you have to preserve all your audit working papers. What is the time limit specified for completion of the assembly of audit documentation? I mean, should it be done before you sign the balance sheet? Our institute and for that matter, the preparers of the standards have understood that in your hurry to sign the balance sheet because of the due dates, deadlines, etc., you may not be able to compile the audit working papers in a proper manner before you finalize the financial statements. So therefore, they have said within 60 days, not more than 60 days from the time you sign the financial report, you should complete your financial audit working papers and put it in the proper place. When we come to the 15th question and 2 more questions, 5 more minutes, who is the auditor working for? This is a very, very serious question which all of us should touch our heart and answer. Are we working for the people who pay for us? The answer is an absolute no. This is a very big problem for the auditor. As against an internal auditor, as against a consultant who is probably working for the person who's paying for you, an auditor is working for the greater good. He's working for the larger stakeholder. Please understand, I may sometimes go to the extent of saying I am not even working for only the shareholders. Now, the shareholders may be appointing me, and I am not even answer. Although my audit report is addressed to the members of the company, the audit report is read by not only the members but also by, let us say, a lender, by a creditor, by the government authorities. So therefore, please keep the larger good in mind. The auditor is certainly not working only for the. He is working for, I would say, the greater good of the profession, keeping the true and fair view intact. And that is why I think our Prime Minister on the CA Day 4 years ago, he went on to say the signature of the Chartered Accountant is more important than the signature of the Prime Minister. This is the second most powerful signature. So let us all be one thing happy about this particular statement, but also remind ourselves about our responsibility, because this he made as a statement to remind us of our responsibility. I always keep telling this, Sharmaji, now that you are on the screen, the cost of greatness. We are a great profession. The cost of greatness is responsibility. We have to behave responsibly in that particular sense. So, and what does the responsibility mean? Responsibility means complying with. Sharmaji, you may be aware, last year you had a good friend and I had a very good chartered accountant as the chairman of Hyderabad branch, Pankaj Trivedi. I told him, sir, do you know what is the meaning of Trivedi? Trivedi means one who is actually a master of 3 Vedas. The Sama Veda, the Rig Veda, and the Yajur Veda. And if you are mastered all the 3 Vedas, then you are called Trivedi. For chartered accountants, the 3 Vedas are accounting standards, standards on auditing, and the code of ethics. So all chartered accountants have to be 3 Vedis in that sense. If at all you are also doing Companies Act, you also have to be a Chaturvedi by following the Companies Act also. So 4 Vedas for chartered accountants. So please keep them intact and put your hand on it and always say whatever I say is true and fair in all respects before I sign the financial statements. Now the last question, 2 minutes I have. Why is it that in spite of so many standards, accounting scams still occur? But this can be a question which Dayaniva Sharma, or for that matter, any chartered accountant, we keep asking this. Acharya, you are talking so much about standards. In spite of so many standards, accounting scams happen. What do you think is the reason? I always keep telling only one thing. In spite of so much of traffic rules, accidents happen. Imagine, is there a mistake with the traffic rule, or is there a mistake with the driver who has actually maybe avoided the traffic rule? So it is not the mistake of the traffic rule. If you think that accounting standards are not good enough, try to remove the accounting standards and then see what will happen. If you think that the traffic rules are not good enough, remove the traffic rules and then you will see the bigger chaos. I think we are to address the bigger chaos. Well, whenever there is, you may be driving a BMW or a Benz, but you may meet with an accident. It is not the mistake of the BMW or the Benz. It is the mistake of the driver. So there can be bad drivers, but not a bad car in that sense. So there can be bad people who are implementing, like what Dayanivas and Subodh spoke in the early part of the session, that there are 330,000 members. If one person commits a mistake, it is a bloat on the profession at large. So let us not be that one person, or for that matter, let there be no one person who is not following the standards in reality in that sense. So I hand back the session to the chair, telling only one statement, that God cannot be present everywhere, therefore he created mothers. Stakeholders cannot be present everywhere, therefore he created auditors. So I think with this sense of being like a mother to the stakeholders, we are as auditors living up to the two words of trust, CA. And I always say, I think we are chartered accountants in practice. We are not chartered accountant in practice. Dayaji, I just have to tell 1 minute. We are practicing chartered accountant because, not because, we always keep telling practice makes a man perfect. Practice makes a man perfect. If practice makes a man perfect, then when will a chartered accountant become a perfect chartered accountant? So we are not using practicing chartered accountant in that sense. Practice what you preach. Practice what you preach. So we are chartered accountants not only preaching standards, we are chartered accountant practicing standards. So let us all be chartered accountants and standard accountants. So with these two words, it's 4 o'clock, I hand over the proceedings to you. So thank you so much.
Thank you, Speaker Sir. I think, Guru Sir, you played a role of a guru in totality to share the important factors of the 3 books, which is the most critical one in the entire profession. The profession is standing from last 72 years, or rather since the time accounting has come into existence, whenever it was, particularly what is called ethics. Ethics is something which you cannot describe. You cannot describe a taste of water. You cannot describe a definition called ethics. You can only give examples and tell that this is what is ethics. This is what can be ethics. So the point which you have driven all across with regards to the basic thing. One thing which I would like to tell Guru Sir, it is not that the chartered accountant or the circumstances have changed anywhere. I think the kind of size with which we are moving around. We were small, we have become large. And the responsibilities is lying on each and every person's shoulder to make it right. As it was being told by Subodh Agarwal sir, that the fact is, if one person does wrong, 300,000 people get impacted because of that one wrongdoing. But what is happening in the process, which I have realized, most of the people have actually understood accounting standard, auditing standards to the extent of passing our examination. But the fact has been very simple. We are actually getting feared away from continuing to do it. What I say in most of the lectures every time when I go as a speaker is, when the day I passed or a person passed from a remotest place of India, both have written the same 8 papers and both have passed with the same 8 papers. There was no exemption for a person who is in Mufasil or I am in city or you are in city. So all of us have gained that knowledge to be on that ground zero when we qualified. But over a period of time, we have actually divided our mind and thinking that, I am from a Mufasil area, I am a small practitioner, I don't have much of knowledge, technology is changing. But I think everyone has adopted. We have changed our houses, we have changed our offices, and we could adapt to everything. This is also one more thing which we need to look at. One saying which I would like to just read it from my mobile. The beautiful thing about fear is when you run to it, it runs away. So the fact is people are actually running away from a fact that accounting standard to be understood, auditing standard to be understood, or company law to be understood, even fundamental things in certain times, tax audits, bank audits, everywhere there has been a gap. The gap has not been intentional, but the fact is it was actually by mistake forgotten. So I think, the process of peer review board, we are just trying to ensure that, we take back everyone to that, fundamental and the pillars of our entire profession and make them understand that, if we have to demonstrate our independence, we have to demonstrate our integrity, if we have to demonstrate the quality of work we have done, only papers can speak. And that is how this entire documentation SA 230 actually comes into existence. What you sign doesn't matter. You sign, it matters. So that is something which we need to really, that is why the chartered accountant signature is very, very critical. I'm just signing one particular document of my sister. The reason of signing this document is only for one reason. The value of the signature exists even today. There has been an exception in the process. Exceptions are always exceptions. We do not have to say. But the larger picture is something which we need to look at. The existence of 72 years in practice makes a whole lot of difference. So I think you have put your thoughts very effectively. And, before we go for the question answer, we had session from 2 to 4. Now we are ended with the session. But what we can do is, if Madam is there, Madam, are you there?
Yes, sir, I am here.
Do we have any specific question which we need to take up for, sir? Or it is a basic...
Some basic questions are there.
So I think we can do one thing, Nidhi Madam, just download the report, share all the relevant questions with her, and then we can post those answers also back from our side. If it is good, okay, Guru sir?
I'm fine. I'll go with what you say.
Yeah, but I think at the bottom line is very clear. As I said, signature matters, and that is why we have been recognized all throughout, the entire business fraternity banking system, or whatever we call, that is becoming very critical, friends. One request which I have from peer review board, as the chairman of peer review board, I'm really delighted that I'm part of this peer review board from last 2 years, and the transition which we are going through. And it's the first time we have made an effect that, a person, again, Subodh sir specifically talked about, when we have people who have qualified their assessment test as a peer reviewer, they will add value to you. Please understand, it is not they are coming there to actually do a fault finding mechanism. Neither we are going to take you anywhere. It's worth that you get assessed, reassessed, and continuously get assessed and reassessed. Because tough times, we do not know when it comes, how it is going to be handled. We don't know. People are not there in the system, in the organization on a continuous basis. People will come, people go. But you, I, Guru sir, who are in practice, we are going to continue our practice as it is. We might have trained hundreds of people, but the fact is, when we want anyone, whether it is client or staff, it actually becomes difficult to get them back. If the documentation, if the process is effectively being kept in mind and kept in file and retained for a specified period, it will make a whole lot of difference. Let's pledge that, when we are going to touch 75 years of our independence, and our independence, 75 years, say continuously it is getting tested. We fought a war of independence might be in 1947, but we fight a war of independence every day in, day out. That is what we need to remember, and always respect that, being a chartered accountant, it matters a lot. And we are few of the privileged ones in the society of 130 crores, 350,000 people, very few, I think. And the percentage, right? So look forward for your participation in the next on the next Wednesday, where we are going to discuss on other various topics. And it's going to be very, very interesting. Please join us. Thank you all. Thank you very much. Thank you, Guru sir, for making it possible. And we promise you one thing, this 7 series program, we are actually hosting on a continuous basis. And this will be listed on our peer review board website, because all these things are handpicked, and we wanted our members to actually go through this learning process effectively. And thanks to you that, people like you are actually coming forward and contributing on a continuous basis to ensure that the fraternity always shines and we always become relevant. We be relevant in all the times to come also. Thank you very much.
Thank you so much for giving me the wonderful opportunity. Thank you.
Thank you, sir.